Ben, this market's been resilient. I know we had a little bit of a speed bump this week, but how do you see things from here?
Look, I think today is interesting because my two themes for the trading today are rates, and you were just talking about this with your other guests, and rotation. You are seeing a market broadening. Tomorrow for PCE, we're looking at 0.3% month over month. Scott, economists are going to tell me do not look at 1 month data. Unfortunately, the market is now very sensitive to 1 month data because the Fed has said we are data dependent. Well, if I'm like a runner, I look at my watch and I see how fast I'm running. 0.3% month over month is over 3.5%. So I expect sticky inflation from here, Scott.
Are you more positive on the market than you've been in a long time? Because in my notes, it says you expect the market to broaden over the next 12 months because we're gently cooling and earnings growth should broaden. That suggests that you're not as cautious. I'll use that word. I don't want to say negative. Is that fair?
Yeah, look, my view is that investors should be close to their risk tolerance, their normal sort of long-term risk tolerance. So call it neutral. You've been talking about concentration. The bears on my asset allocation committee are worried about concentration. It is an economic slowdown. And Scott, from here, the sentiment, sort of shorter term indicator, is running pretty hot. Yeah, today, software is not doing well and tech is selling up. But sentiment, if you look at retail surveys, or even the VIX touched 11 last week. It's 13 this week. So this sort of positioning and these high expectations. Scott's a wise person once told me that the secret to happiness in life is to have low expectations. The expectations, and you see this in software today, but for tech and for AI, are just really, really high. All that being said, Scott, earnings are coming up. Rates over time are coming down. I don't expect a recession. I think stocks will do okay. I think credit will do okay. And I'm pretty comfortable for the next 12 months.
But that's a change. I mean, let's be honest, right? That definitely sounds like you have changed more positive on these markets. And I was going to ask you, how could you possibly be negative if those are your views? Don't expect a recession. A hike is unlikely. Market's going to broaden. Earnings are good, right? I mean, you're building the case that maybe you want to be more invested in this market than you were before, or at least more overweight U.S. equities than you were willing to be prior.
Yeah, look, we've been talking for a while, Scott. We closed our underweight stocks back in October, right? And the market at the time was down 10%. You called me a reluctant bear. I called myself a reluctant bear for parts of 2023.
No, you called yourself that. I just kept calling you that because even when the market was showing signs of bull market, you were still a reluctant bear.
Right. And so in October, we closed it, and I wish we'd done more, but we closed it pretty fast. We bought $3 billion worth of stocks, and we've been neutral since then. We've actually added a little bit to stocks, Scott, to your point. Look, I think it just comes down to being aware of the short-term risks with very high expectations. AI is like a tidal wave, and right now, as Stephanie Link talked about that during lunch, in her conversation with you at lunch, but right now it's sort of building AI, semiconductors, cloud computing, and now it's spilling. The wave is going to, copper prices, utility. But ultimately, we believe this is real. It's going to be a wave that's going to go into more traditional companies to create productivity. And all I'm saying is the expectations for that wave are extremely high, especially right now. So that's what you're seeing in terms of disappointment in tech today. So, stick to your long-term risk tolerance. As an investor, how much risk do you want to take? And Scott, if you allow me to talk about longer-term asset allocation, if you're far away from retirement, if you look at life cycle models, which we use in some of our portfolios, you should be, let's say you're 10, 15 years from retirement, you should be, according to life cycle models, 70, 80% stocks, right? So what I'm talking about is understand your risk tolerance. And this is the kind of market where you kind of want to be where your risk tolerance is.